Hello, I'm Kim Stafford, and I'm here again with PIMCO Group CIO Dan Ivascyn to give you an inside look at some of the recent discussions taking place within PIMCO's Investment Committee, or IC. Dan, thank you for joining us.
Thanks, Kim.
You kicked off the year with some global travel, spending time with our investors outside of the U.S. In fact, you happened to be on the ground in Asia during the recent election headlines and volatility in Japanese bonds. What stood out to you about how investors are thinking about markets? What were the range of perspectives around asset allocation and risk preferences?
This time of year, I do tend to hit the road and meet with clients around the globe. And at these various events, we do surveys as well. So we actually have some hard data in addition to a lot of investor conversations. There were a few themes this year. One, general optimism towards economic growth, excitement about the riskier areas of the financial markets, a lot of excitement about global equities, a lot of excitement about the clients' respective local market equities, but still not a tremendous amount of interest in global bonds or global fixed income. So again, a risk-seeking mindset, but also a mindset where there is increasing anxiety or concern about some of the global themes or global uncertainty. Policy uncertainty, geopolitics was another area of focus for investors. So I think the bottom line is that investors are still confident. They are perhaps less focused on the global opportunity set than we are at the moment. But I think that creates great opportunity.
You've said previously that it's always important to compare the macro outlook with what's already priced into markets. When you make that comparison, where do you see pockets of value and where do you see potential signs of complacency or risks?
We are confident about global growth. We are confident about U.S. growth, particularly during the first half of this year. But when you look at risk markets, a lot of this is priced in. Maybe more optimism than is warranted is priced in when you look at very, very tight credit spreads, particularly tight credit spreads in the riskier areas of the credit markets. Then global equities are at elevated valuations. You combine that with the optimism I talked about earlier in terms of various client surveys and discussions would suggest that a lot of the good news is priced in. Our job as active allocators across markets is to look at what's embedded and implied in pricing. A great opportunity is when you see significant optimism in one market, pessimism in the other. That invites a relative value opportunity. Over the last several weeks alone, we've had volatility in Japan, volatility in the UK associated again with politics, which then bleeds into France. You have China at a very different part of their growth cycle where they're dealing with disinflationary forces while we have elevated inflation in Australia, across Europe, and in the United States. It's a unique environment, and an environment where you can do these simple relative value comparisons, and it can uncover a lot of attractive opportunities. And I think that's why, we say that in high quality fixed income, your starting yield is a really, really good assumption in terms of the floor, in terms of expected return. But today, with steeper yield curves, more localized volatility, more policy uncertainty, you can add on to that base case yield by making thoughtful asset allocation decisions along the way, especially if you maintain portfolio liquidity, which means flexibility to react to future uncertainty. That's very, very different than the model or the choices that investors had a decade or so ago when yields were low or negative with very little volatility. You had to lock up your money. You had to buy some of the riskier investments to generate that high yield. We're in a very different environment. So again, we do think this is an environment where investors should acknowledge that a lot of optimism is embedded in prices. There's reasons to be optimistic, but from an asset allocation perspective, we think you can generate similar or even higher base case yields with more resiliency, more liquidity, more future flexibility than some of the popular strategies that have done well on a historical basis, but probably don't do as well going forward.
Investors have enjoyed a long AI-led stock market boom. Lately, we've seen volatility amid AI concerns, including industry disruption, capital spending growth, and borrowing needs. From your vantage point, how is AI investment changing markets, and where do we see investment opportunity?
AI is a very important, innovative, and disruptive technology. It will, over the near term, drive growth forward. But anytime you have a disruptive technology, there are going to be some winners and losers. And even in a strong economy, even in an environment where overall equity prices continue to go higher, they're going to be losers. So you have to be absolutely careful about this disruption. In some sense, looking back at my career in the business, I remember early stages of the global financial crisis. People knew something was going on, didn't quite know what was going on. And again, the outcome surprised many investors. Early days of COVID. And I remember an Asia trip around the same time where I returned to the States and it felt like something major was going on. But again, it created a lot of uncertainty. I think AI is a similar type of situation for markets. We're in the early stages. Things are moving very, very quickly. And anytime you have this type of environment, you have to be prepared for the resulting disruption. Again, what that means to PIMCO is up in quality. Be careful about locking up your money if you're not getting paid sufficiently to do so. Be careful about leverage. Be careful about concentrations, which gets back to this attractiveness of global diversification. Focus on sectors that are less prone to disruption, more granular risk, like asset-backed risk, hard assets backing your investments. Conservatism in terms of underwriting. All these are very, very important themes on a go-forward basis. And all of these themes can be exacerbated if you have some type of negative growth shock. So I think the playbook has to be different than the playbook that investors have utilized over the last decade or so. But I think that the good news, again, is where we started the conversation, is that there's this very, very attractive, high-quality global opportunity set. But I do think that these asset allocation decisions will be quite consequential for absolute and relative returns going forward.
Great. Well, thanks very much, Dan. And thanks to all of you for joining us. We'll see you next time.